You have finally saved 500,000 Kenyan shillings, maybe from your bonus, your side hustle, or months of consistent saving. That's a big milestone. But this is also the moment most young high-income earners lose money. Because they rush to invest without asking, am I actually ready to invest this money? Before you move your 500k into any investment, whether stocks, money markets, or land, make sure you've built the foundation for long-term success. Think of investing like building a house. The foundation comes first. Before your money can grow, it needs to be protected, clarified, and then deployed. Here's what I mean. Grow, invest intentionally, not emotionally. Clarify, know your goals and time horizon. Protect, have an emergency fund and insurance. But most young high-income earners skip building an emergency fund and having insurance. They also ignore clarifying their goals and time horizon. They go straight to investing and end up selling investments when life gets hard. Let's assume you put your entire 500,000 Kenyan shillings into a plot. At first, it sounds like a great deal, fast-growing area, high returns. But when an emergency hits, you can't sell it. You end up stuck with no liquidity and peace of mind. That's the trap of investing before building a financial cushion. Before you invest your 500k, let's run a quick readiness check. Give yourself a yes or no for each of these. Do you have an emergency fund covering at least 3 to 6 months of expenses? However, the typical 3 to 6 months of savings may fall short, especially for young high-income earners with steeper living costs. Aim for 9 to 12 months of expenses for greater security. Do you have medical and income protection? Are you free from high-interest debt? Have you defined what this 500k is meant to achieve? Do you know your investment time horizon? If you answered no to even 2, hold off. You're not quite ready to invest yet. The second layer is clarity, your why. Are you investing this 500k to build wealth long-term? Save for a property deposit? Or start a business in 2 years? Your why determines your time horizon, which shapes your risk tolerance. For example, if you need the money in 12 months, you can't put it in volatile stocks. If you're investing for 5 to 10 years, you can take more risk and go for growth. Keep in mind that money decisions made in a hurry often lead to regret. Financial freedom is not about how fast you invest, it's about how clearly you invest. If you start with structure, your 500k becomes the seed that grows your wealth tree. If you start with emotion, that seed might never sprout. So before you invest, build your base, ensure you've emergency fund, insurance protection, defined your goal, and determined your time horizon. Once you've done that, you're ready to structure and invest your 500k intelligently across Kenya's best opportunities. So you've got 500,000 shillings ready, and you're wondering, where should I actually put it? In Kenya today, everyone has an opinion. Some say buy land, others say go for stocks, or try money market funds. But there's no one-size-fits-all. What matters is how that 500k fits your goals, your time horizon, and your risk tolerance. Let me show you exactly how to structure your 500k into a smart, balanced investment strategy that works. Think of your 500k like a pie. You want to slice it in a way that balances growth, stability, and liquidity. Here's a simple sample. First, about 40% goes into equities. That's your long-term growth engine, things like shares, ETFs, or equity unit trusts. Next, 30% into money market or balanced funds. Think of this as your steady driver. It gives you moderate, consistent returns while your equity side does the heavy lifting. Then we have 20% in fixed income or bonds. This is your safety belt. It keeps your capital stable when the markets get unpredictable. And finally, 10% for alternatives, which could be your side hustle, a small startup idea, or a short-term opportunity. So when you think about investing 500,000 Kenyan shillings, don't just throw it all in one basket. Build your own balanced pie, one that grows, protects, and creates opportunities along the way. Now, depending on your profile, this pie can shift. Let's talk about how your 500,000 Kenyan shillings investment pie might actually look. And remember, this isn't a one-size-fits-all formula. Your mix depends on your investor profile. Basically, how comfortable you are with risk. If you're conservative, you want to protect your capital first. So about 60% of your money goes into stability, things like treasury bills and money market funds. Another 20% can go into growth, maybe low-risk funds, and the remaining 20% stays liquid, ready for quick access. For a balanced profile, you're open to some risk, but you still want stability. So here's a nice mix: 40% growth, 40% stability, and 20% liquidity. That could be a blend of funds, maybe a few stocks and a money market fund, as your cushion. And if you're aggressive, you're playing the long game. You'll put more into growth, about 60% think stocks, ETFs, and even global markets. Then keep 30% in stability, and 10% in liquidity just for flexibility. So depending on your profile, this investment pie can shift. The key is knowing your comfort level and goals before slicing it up. Which pie looks like you right now? Drop it in the comments: conservative, balanced, or aggressive. Here is an investment strategy to inspire you. Imagine you are 30 years old, earning $250K per month. You have saved $500K and want to grow it for 5+ years. Your $500K pie may look like this: $300K in equities via a unit trust and a few NSE blue chips, $100K in a money market fund for liquidity, $70K in treasury bills, and $30K exploring a small, low-risk side hustle. This strategy is balanced, diversified enough for growth, yet safe enough for flexibility. Let's break down where your money can actually go. 1. Equities and stocks. These are listed companies like Safaricom or Equity Group. You can invest directly or through equity funds. 2. Money market funds. They're great for liquidity, but remember, returns are taxable, 15% withholding. 3. Treasury bonds and treasury bills. These are issued by the Central Bank of Kenya. They protect your capital and pay predictable returns. 4. Real estate investment trusts allow you to invest in property without buying land. And lastly, alternatives. Think small side businesses, startups, or SACCO shares. While they offer higher predictable returns, they also have higher risk. So don't put everything there. Now, here's something I see many young professionals miss: diversification isn't just owning many investments. It's owning investments that react differently to market changes. For example, when stocks dip, your MMF cushions you. When the shilling weakens, global ETFs might strengthen. In Kenya, some common investment risks include political cycles. Every election year, markets become volatile and investors pull back, prices swing, and uncertainty creeps in. So instead of panicking, keep some money in a money market fund. That way you stay liquid and can take advantage of opportunities after things settle. Next, inflation, the silent wealth killer. When prices rise faster than your returns, your money quietly loses power. To protect yourself, add growth assets, like equities or real estate that can outpace inflation over time. Then there's liquidity risk. You might own land or a private investment that looks good on paper, but if you ever need cash fast, it's tough to sell. That's why you should always stay partly liquid. Have some investments you can easily access when needed. And finally, currency risk. When the Kenyan shilling weakens against the dollar, imports and global assets get pricier. Make a smart move by diversifying globally. Also invest in USD-linked assets or funds to balance your exposure. At the end of the day, you can't avoid risk, but you can manage it. Control what you can, and your money will work for you, not against you. So how do you implement your $500K investment plan? Follow these simple steps. Step 1. Open the right accounts: T-bills, ETFs, or SACCO. Step 2. Allocate investments based on your risk profile. Step 3. Automate, set standing orders to MMFs or unit trusts. Step 4. Track your performance monthly. And lastly, rebalance annually. For example, if you ignore your portfolio for a year, you might miss a RIT dividend and lose compounding gains. Don't let that be you. Consistency is how your $500K grows into $1 million, not by chasing trends, but by following structure. Keep in mind that your $500K needs direction, not excitement. Build your $500K pie with balance, liquidity, and patience. And remember, returns mean nothing if your money isn't aligned with your goals. Now, I'm going to show you how your 500k actually grows, projections, compounding, taxes, and how to reach your first 1 million. If you invest 500,000 Kenyan shillings today, how long will it take to hit your first 1 million? A year? 5? Or 10? The answer depends on one powerful principle: what you do after you invest. Because investing isn't just about starting, it's about growing. Let's map your journey from 500k to 1 million shillings, step by step. Imagine your 500k earning 10% per year, that's roughly 50k annually. But if you reinvest those returns, year after year, your 500k becomes over 1 million shillings in 7.5 years. That's the power of compounding. Your returns start earning returns. Now if you add just 10,000 Kenyan shillings monthly, you cut that time almost in half. Because consistency beats timing, every single time. What about if you reinvest dividends? Let's say you have a portfolio paying about 6% in dividends, but you withdraw the cash every year to reward yourself. When you run the math, you realize that by reinvesting, you'll grow your 500k to nearly 1.2 million shillings in 8 years, but instead, you sit at 800k. Here is a growth scenario table. These are realistic numbers for Kenyan investors. Between money market funds, equity funds, and bonds, an 8 to 10% annual return is possible. But again, the magic isn't in chasing higher returns, it's in building a plan that you actually stick to. If you earn a good salary, adopt what I call the salary escalator mindset. Every time your income rises, increase your investment contribution, even by 5 to 10%. For example, if you invest 500,000 Kenyan shillings once, and add 10k monthly, you'll hit 1 million in about 5 years. But if you increase the top-up by just 2,000 Kenyan shillings every year, you could reach 1 million a full year earlier. Small consistent moves result in huge results. Your money grows only as fast as your discipline does. Growth isn't always smooth. Markets fluctuate and inflation bites. So your secret weapon is risk management. Do these 3 things. Keep 10 to 20% of your portfolio liquid in MMF or T-bill. Rebalance annually by shifting profits from stocks to safer assets, and lastly, track your net worth every quarter. This protects your gains and keeps your 1 million goal within reach. Most investors fail, not because of bad investments, but because of bad behavior. They panic when markets drop, chase hot tips, and forget their plan. Don't do that. Keep a written investment policy, your rulebook. When things get emotional, your plan keeps you grounded. Follow this checklist: don't chase quick profits, review quarterly, reinvest returns, and stay patient. When you invest 500,000 Kenyan shillings wisely, you're not just building wealth, you're building momentum. That's what separates the average saver from the strategic investor. The goal isn't just 1 million, it's to become the kind of person who can keep multiplying it. Start small. Stay consistent, and scale smart. Now that you know how to grow your 500k, implement this plan, track your portfolio, and get ready for your first million. And don't miss my next video, How to Invest 1 Million, where I'll show you exactly how to scale your wealth even further.